By now, you will hopefully be starting to know what really makes the markets move and what advantage you will have if you can start to learn to anticipate what the market maker is up to before they make their move. In this lesson, I'm going to take you through the three most important elements to the market maker. If these are the three most important things that they consider in the markets, then so should we. This slide that you're looking at right now is probably one that you should screenshot and have easily viewable to you and available when you trade, because I guarantee you, when you actually start trading and it gets time to entering a trade, you will easily forget to consider at least one of these elements in your trade decision. And that is a big mistake. The three most important elements to the market maker in order are the pattern, the timing, and the levels. So let's go through what each one of these actually means. The pattern refers to the market maker's business model. This was covered briefly in the one formation video, but we are going to go through it in detail today. Smaller patterns like the M or W formation, rises and drops, reversals and consolidations, all make up the larger market maker's business model. This is not a one time frame method. This business plan will play out on different time frames at different times. It all comes down to how much the market maker is able to lend out, which allows the model to feed into higher and higher time frames. Usually you will find at the end of a very, very drastic move, we will go into an extended period of consolidation. This period of time is where the market maker is building their position, and the longer this time goes on for, the longer they can let the following trend go for. For you learning this method, it's best to try and identify it first on the 5 or 15 minute time frame. That doesn't mean trade it there. It just means look to see if you can identify what's happening there. Once you see a full pattern play out, go up a time frame and see if you can see an incomplete model there. If so, stay there until you can identify that it's complete. And once you've done that, go up a time frame again. And then you just keep repeating this until the pattern breaks. That's when you know the market maker has reached their limit. Once the model breaks, you simply just start again. Back down to the 5 minute, trying to identify the model beginning there and so on. Before you go to bed each day, remember that if the market makes a big move, it will be followed by a big move the other way at some point. You don't have to stick to one time frame. You simply need to determine the conditions of entry on the correct time frame based on what the market provides. In order to beat the market maker, you have to understand how they set up their moves and what exactly is going on. The pattern consists of trap moves, which are made at the beginning of the week, which is Sunday, Monday, depending on where you live in the world. The idea is to clear the leverage that's on the board from all the weekend retail positions that were opened up, stop them out as their way of building their own contracts before they can make the next big move. Once that's done, an M or W will likely follow. To put it simply, an M is simply a high followed by a lower high, and a W is simply a low followed by a higher low. The M and W just get a lot more detailed than this, and there are variations of it, but for now, I just want you to focus on the general shape. This shape traps traders in the wrong direction during the first peak, which is often a fast, dramatic move until the candle closes. Then the market maker moves price away from that peak and later on returns close to it, but not close enough to release those trapped traders. This is what creates the second peak. Now that the market maker has trapped traders in the M or W, they can shift price through 3 levels of rises if following a W, or 3 levels of drop if following an M. Rises and drops are essentially just levels. These levels can trend or they can consolidate, but what makes them different to other price action is the volume. Volume will spike abnormally in comparison to candles surrounding it, and this is our hint that the market maker is running their business. In between levels, there can be periods of consolidation or also a retracement, and at TTC we call these board meetings. But there doesn't have to be. They're called board meetings because that's exactly what is happening. Anytime you see price move sideways in consolidation, 2 things are happening. The market maker is accumulating contracts for the next powerful move, number 1. And number 2, the market maker is literally in a board meeting, assessing the leverage that's on the table, assessing whether or not the last big move gave them enough ammunition to go for another level, or do they need to induce more traders into bad positions in another period of consolidation because they need to have more leverage and liquidation levels available before they can then let price fly. If there is no board meeting between a level, then the market maker already had what they needed to keep going. If there is one, then we know that the market maker is accumulating contracts, and we have to learn to read that period of consolidation to get an idea of what move the market maker is going to make next. In a typical week, price will rise following a W formation for a period of 3 levels or 3 days. Following an M, price will drop for 3 levels or 3 days. Once those levels are completed, we look for wicks to turn from one side of the candles to the other, and this is our hint a reversal may soon follow. We then wait for the M or W at the other end of the 3 days or the 3 level trend, and look for our trigger on the second peak to get an entry for the next 3-day or 3-level trend. This is the midweek reversal, and typically this reversal will line up with a news event. It's not because speculators are reacting to news, as the media will have you believe. It's because the move was coming anyway, and the market maker uses the news as the excuse because people will believe it. If price is randomly and suddenly changing directions for no reason, people would start to question why. Have you ever noticed economical results come out and the numbers show that the Dixie should fly and everything else should dump, but the opposite happens and you're left wondering why? Why is because the result doesn't matter at all. What matters is retail sentiment. If retail believe beforehand that the news is going to be great for the markets, the market maker will typically drive price up pre-news for like a day or two before. And this gets retail believe they are getting in early. Then comes the news event. Regardless of the outcome, they will issue the midweek reversal and take back all they lent out earlier. And of course, that can happen the other way as well. If retail are bearish on the upcoming news, then the market maker can run the 3-day trend to the downside and reverse it on the news event to the upside. So news doesn't really matter, and results of news also don't really matter. All that really matters is what retail sentiment pre-news and what date and time is the news event. If the news event lines up around midweek, which in crypto it's Wednesday or Thursday, we expect the midweek reversal will come in then. If retail sentiment is bullish on that news, it's likely the market maker will issue a W formation early in the week, then run a 3-level rise into the news, then issue the reversal out of the news. Then finally Friday comes and the market maker will issue the weekend trap. They do this because they clock off after the US session close, but they want committed traders throughout the weekend so that when they come back to work Sunday 5 p.m. New York, they have leverage on the table that they can take advantage of come the false move week beginning. And then the cycle begins again. Let's take a look at what this looks like with real price action. So here's a typical week. On this chart, you can see the smaller patterns that make up the larger pattern, which is the market maker's business model. So you should be able to see here that on the left-hand side of this screen, the weekend trap is highlighted in that box there. And that's where price just went sideways all weekend. A spike high out of the weekend trap led to the false move week beginning to the downside. Then we followed with a W formation, which is highlighted in that green arrow. Following that, we had a level 1 rise, and then from after that level 1 rise we went into the board meeting, which is marked in a box there as well. Following that board meeting we went into another 2 levels of rises. Between level 2 and 3 there was a mini board meeting, but see how that one didn't need to go on for too long? That would be because the market maker didn't really need to accumulate that many contracts in order to get to the next level. Now in this particular case on this chart, we had what we call a final damage M formation. I will talk about those when we get to the M and W lesson in this course, but for now just know that that is classified as an M formation. We then had 3 drops. After the level 1 drop, we went into a board meeting and price went sideways, but after the level 2 drop, we actually had a retracement. So in between levels, we can either just go sideways or price can attempt to retrace. If it does attempt to retrace, we're usually looking for it to reject at one of the vectors that was created during the levels, because the levels are levels only because they create vectors. And on Friday, the trap was issued into the week. We're going to zoom in on this shortly. For now, just take notice of the shapes. Now, all of this happens in combination with the second most important element, and that being the timing.